Please like, share, and subscribe. Wishing you happiness and good luck every day.
Let's be honest, personal investing can feel like you're trying to solve a puzzle with way too many pieces. But what if the solution wasn't about finding more pieces, but about using a completely different instruction manual? Today, we're diving into the core ideas from The Perfect Portfolio by Leland Hevner, a book that claims to offer exactly that, a simpler, more powerful way to build your financial future. I mean, does this feel familiar? You've got the constant buzz of financial news, all this conflicting expert advice, these super complex trading apps. It's the perfect recipe for analysis paralysis, and you know what? It's kind of designed to make you feel that way, completely overwhelmed. And when we feel overwhelmed, what's our first instinct? We hand over the reins, right? We let someone else deal with it. Well, the book argues that this is the real problem. In our search for simplicity, we often end up giving away control over our own financial security. So here's our game plan. First, we're going to really look at this modern investor's dilemma. Then, we'll get into the revolutionary new method that's supposed to solve it. We'll break down how to build its foundation, how to potentially supercharge your returns, and finally, how to make it all work for your life. Okay, so let's start right there, with the problem itself. What exactly is this modern investor's dilemma we're talking about? It's really a perfect storm. You've got this nonstop noise from the media, confusing advice from so-called experts, tools that are way too complicated, and all of it just creates this immense pressure that pushes us towards one single decision. Just let someone else take the wheel. And that is how investors can end up feeling totally powerless. But what if being powerless isn't the only option? The book argues that the answer isn't more data or more complexity. It's actually a fundamentally different and way simpler approach. And this is it. It's called the Perfect Portfolio Methodology, or PPM for short. Now, listen to the promise being made here, because it is a big one. Incredible returns under any market condition without unacceptable risk. Okay, that's a seriously bold claim. Let's see how the book plans to back that up. So the PPM is built on this simple three-part journey. First, you design your core segment. Just think of this as the stable, rock-solid foundation of your portfolio. Next, you add what's called a target market segment, which is like the engine designed to boost performance by zeroing in on specific opportunities. And then finally, you combine them in a way that fits your unique goals. It takes this huge, scary concept and breaks it down into manageable steps. So let's zoom in on that first absolutely critical step, building your foundation. Because this is where the perfect portfolio method really starts to challenge all the conventional wisdom we've been taught. It all starts with a single, really important number, 9. So what on earth does the number 9 have to do with investing? Well, here it is. While most financial advice you hear is all about just 3 asset classes, stocks, bonds, and cash, the PPM expands that whole universe to 9. And this isn't just about adding more things for the sake of it. The whole point is to create a portfolio that can find opportunities and manage risk no matter what the traditional markets are doing, by using assets that don't all move in the same direction. And this is what that actually means for you. The image on the left, that's the traditional way. Endless, complicated analysis, trying to pick individual winning stocks, which always carries the risk of a single company just failing. The approach on the right, it just sidesteps that whole game. By investing in broad asset classes instead of single companies, you virtually eliminate that specific company risk. It's a huge shift from being a stock picker to being a strategist. Okay, so simpler and safer. That's a pretty great start. But remember, the book also promised incredible returns. So how exactly does this method aim to supercharge performance? This quote really gets to the heart of it. This whole thing isn't about hiding from market swings or being scared. It's about a complete mindset shift. Learning to see market challenges not as threats to your money, but as potential profit-making opportunities. It's about playing offense, not just defense. So the book makes a pretty provocative claim about why this method isn't talked about more. It suggests that some financial advisors might not want you to know about it because it's designed to empower you to succeed on your own, which, of course, could potentially cut them out of the picture. And that really brings us to the most important point, because a method, no matter how clever it is just a tool. The real, ultimate goal here is to build a portfolio that serves your life and your unique goals. And that mission comes directly from the author, Leland Hevner. As the president of the National Association of Online Investors, his work has been all about one thing: empowering individual investors by giving them the tools they need to succeed on their own terms. And that really is the core message of this entire approach. It is all about a fundamental power shift. The goal is to demystify this whole process, taking control away from a complex industry and putting it firmly back in your hands, right where it belongs. So, we're going to end right where the book begins, with a question. Now that you've seen a little glimpse of a different path, one that's built on safety, simplicity, and performance, the only question left is, are you ready to take control? All right, let's just jump right in. Have you ever felt like managing your own money is this impossible maze, just a ton of noise, conflicting advice, and straight-up chaos? Well, if you have, trust me, you are not alone. Today, we're going to pull back the curtain on why personal investing feels so broken for so many people, and more importantly, what we can actually do about it. I mean, really think about it for a second. You're getting hit from all sides, right? There are hundreds of books, endless seminars promising you'll get rich quick, and this 24/7 fire hose of news from the financial media. It's almost like it's designed to be overwhelming. And honestly, for most people, it really, really works. This quote from an investing teacher just hits the nail on the head. He's talking about his students. We're talking doctors, lawyers, teachers, entrepreneurs, people who are sharp and successful in their own fields, but feel completely lost when it comes to their own money. It's a problem that cuts across everything. So yeah, let's just call it what it is. For the average person out there from Main Street, the world of personal investing is fundamentally broken. The financial services industry, as it stands today, just isn't built to serve people who want to take real, meaningful control of their own financial destiny. And when you're faced with that kind of complexity, what's the natural reaction? Most of us just throw our hands up and give in. We hand over our entire life savings to a financial advisor who might have their own agenda, and we just cross our fingers and hope it all works out. But for a lot of people, that just doesn't feel right. It's a total loss of control. Probably the best way to really get a handle on this problem isn't by looking at charts and data, but by listening to actual people. So let's check out a few stories from an investing classroom that might sound, well, a little too familiar. Okay, so first, meet Margaret. She's a 58-year-old teacher. She's done everything right, saved up a really nice nest egg. She's entrusted it to an advisor, but she's got that pit in her stomach, that feeling that something's not quite right, but she's almost too intimidated to even ask what's going on. And when you look closer, you see all these classic red flags. She's paying a huge 2% fee every single year, but her portfolio isn't even keeping up with the market. There's no clear plan. It's just this random jumble of mutual funds that all have sales commissions baked in. When you add it all up, it starts to look like her portfolio was built to make her advisor money, not to help her retire. All right, next up we've got John. He's a 42-year-old lawyer, a really smart guy. He walks in one day, super excited, with a list of stocks he got from a TV show he watched on a Saturday morning. He's all ready to dive in head first. John's mistake is one that millions of people make. He's taking tips from so-called experts on TV, hasn't done a lick of his own research, and even admits he's just trying to make a quick buck. What he didn't get is that those shows, their number one job isn't to give you good advice, it's to get eyeballs so they can sell ads. It's financial entertainment, not financial research. And then you have Suzanne. She's a high-level government employee, and she needed a little extra cash for her son's college tuition. A friend gave her a hot tip on a high-risk fund, and she jumped in. This is such a classic trap. The fund went on a tear. It shot up 50%. A huge win, right? But Suzanne never sold. She never took those profits off the table because she had no plan. She just held on for the ride, all the way down. It ended up dropping to 25% below what she paid for it. The industry loves to tell you what to buy. They almost never talk about the other half of the equation, when to sell. And finally, there's Mike, a 62-year-old retiree. He went to one of those free lunch seminars, super high energy, promising he could make a ton of money from home with their simple trading system. And man, he was hooked. Oh, the pitch was so good. Just pay $5,000 for the training, another fee every month, and follow the little green arrows on the screen. Easy. But it was just pure snake oil. The whole thing was a masterclass in high-pressure sales tactics designed to make people feel like they're going to miss out if they don't buy right now. It just preys on that desire for an easy answer. And really, it all comes down to this one simple question. If this system was so amazing, so foolproof, why are these guys flying around the country, staying in cheap hotels, trying to sell it to people like Mike? The answer is pretty obvious, isn't it? The real product they're selling is the system itself. So, look, these stories aren't just isolated incidents. They're symptoms of a bigger disease. They perfectly illustrate the 4 huge obstacles that are systematically put in front of regular people who are just trying to do the right thing with their money. You've got the advisor bias that Margaret ran into. You've got the so-called expert opinions from the media that fooled John. You have the slick marketing machine that almost got Mike. And holding it all together is the biggest one, a massive lack of education. Because here's the industry's dirty little secret. They make more money when you, the investor, are kept in the dark. And this just lays bare the huge disconnect. The industry sells complexity and chaos, but what we really need is simplicity and structure. They sell hype and hot picks, but we need education and real research. They hide behind commissions and fees, but we need control and transparency. They want us to be dependent on them, but what we really need is the confidence to be independent. It's a total mismatch. Okay, so that's the problem, and it's a big one. But here is the good news. We don't have to play that game anymore. There is a different way. We can change how we approach investing, and there's a clear path to taking back control. A better approach has to do all of these things. It has to be easy to understand and actually put into practice. It needs to be simple to keep an eye on, flexible enough for changing markets, and tailored to your life. And yeah, the whole point is to get better returns without taking on insane risks. These aren't just suggestions, they're the absolute must-haves for any strategy that puts you in the driver's seat. So how do we get there? Well, the first big idea is just a radical simplification. Instead of trying to find that one needle in a haystack, that one stock that's going to take off, you just invest in the whole haystack. You invest in entire markets. This one shift takes you from thousands of overwhelming choices down to maybe a handful. It changes everything. And the tool that makes this all possible is something called an exchange-traded fund, or ETF. Just think of it like this. An ETF is like a basket that holds hundreds or even thousands of stocks, but you can buy or sell that entire basket in one single trade, just like a single stock. It's the key that unlocks this entire simple, powerful strategy. And the final piece of the puzzle is technology. Today, there are amazing and totally free web tools that can automate almost all of the portfolio monitoring for you. You don't have to be staring at a screen all day. You can set up your system so it only tells you when you need to pay attention, giving you control without it taking over your life. So when you boil it all down, the choice is pretty clear. You can keep playing a game that's often rigged against you, or you can use a new approach, one built on simplicity, modern tools, and your own knowledge to finally, truly take charge of your own financial future. Which really just brings us to the last and maybe the most important question of all. After seeing how the system works, are you ready to stop being a passive customer who's constantly being sold stuff and start being an active, confident investor who's in charge of their own destiny?
Are you tired of all the complicated investing advice out there that just doesn't seem to work anymore? Well, today we're going to break down a simpler, way more powerful approach called the perfect portfolio methodology. Let's see if this is the key to finally getting the control you've been looking for.
All right, let's just dive right in with a pretty big question. For decades, we've all been taught the same basic rules of investing. But with the markets changing at, lightning speed, you got to ask yourself, is that old school wisdom really cutting it for us today?
And this quote, it just hits the nail on the head. It really captures that frustration so many people feel. It's like the financial world is moving forward, but the advice we're getting is just stuck in the past. And that can leave a lot of investors feeling pretty lost.
I mean, does any of this sound familiar? You spend hours, maybe even days, analyzing a stock. You think you've got it all figured out, and then bam, some random news story sinks it overnight. Or you're trying to guess which is going to be the right move. Is it large cap this year? Small cap? It's a process that can feel totally exhausting and, let's be honest, kind of broken. It's funny how sometimes the biggest breakthroughs come from total chaos. The 2007 financial crisis was absolutely devastating, no doubt about it, but it also gave us this unique moment of clarity. It was that market meltdown that actually sparked the core idea for a whole new way of looking at our portfolios. So here's what they noticed. During the crisis, individual stocks were just all over the place, completely unpredictable. But something fascinating was happening with entire categories of investments, asset classes, things like gold or energy. They were behaving in surprisingly logical ways. Their performance was tied to these big macroeconomic trends, the kind of stuff you'd read about in the headlines.
And that led to this huge light bulb moment. A simple but incredibly powerful idea. What if, instead of trying to pick the single best energy stock, you just invested in the entire energy sector? This shift, right, from focusing on single companies to these broad market trends, well, that's the foundation for this whole new methodology.
So if we're going to invest in a new way, we're going to need a better set of tools. Let's take a look at how this new approach basically takes the old, very limited investor toolkit and expands it into something much, much more powerful.
For what feels like forever, this has been the standard playbook, right? Every portfolio was just some kind of mix of these three things: cash, stocks, and bonds. That's it. When you think about it, it's a really limited palette to work with, especially in the kind of complex global economy we have today.
But the perfect portfolio methodology, it completely blows that up. It says that to build a portfolio that's truly flexible and powerful, you need 9 distinct building blocks. And believe me, just this simple expansion, it changes everything.
And here they are. So we keep the traditional 3, of course, but then we add 6 new categories, like gold, energy, and emerging markets. Now, these 9 weren't just picked at random. They were chosen specifically because each one reacts differently to big economic events. For example, when stocks are going down, gold often goes up. And it's that diversity that's the real secret sauce to creating a more balanced, less volatile portfolio.
Now this is a really powerful concept. Think about what this means for a second. The methodology is basically saying you don't need to spend your life sorting through thousands of different stocks and funds. Your entire portfolio can be built using just these 9 core investments. That is a massive simplification.
Okay, so we have these 9 blocks. How do they actually work together? Well, it's not just a random pile of investments. They're all thoughtfully arranged into a really simple 2-part structure that's designed for both safety and performance. The easiest way to think about it is your portfolio now has 2 parts. First, you have the core segment. This is your rock-solid foundation, broad, low-cost buy-and-hold investments that you pretty much never touch. And then you have the target market segment. This is like the supercharger for your portfolio, where you can actively invest in things like gold or energy to really aim for those market-beating returns.
So what does this actually look like in practice? Here's a simple example. A moderate investor might put 60% of their money into that stable core foundation, and the other 40% into the higher growth target segment. Just that one decision right there sets the entire risk and return profile for your whole portfolio.
But here's the best part. This is not a one-size-fits-all system. Not at all. The real power here is in its flexibility. It lets you fine-tune your portfolio so it perfectly matches your own goals and your own comfort level with risk.
I love this analogy. The whole process is like adjusting a couple of dials on a stereo. The first big dial sets your split between that stable core and the growth-focused target. Then you've got smaller dials that let you adjust the mix of assets within each of those segments. It's so intuitive, and it puts you squarely in the driver's seat.
And here's exactly how that main dial works. If you're an aggressive investor, maybe you crank that target segment up to 70% for higher growth. But if you're more conservative, you might put 80% into the stable core. See? You have total flexibility to choose what feels right for you.
So what's the big takeaway here? Let's just wrap this all up. The perfect portfolio methodology really offers a clear path forward. It's simple, it's powerful, and it's totally customizable. It shifts your focus away from the impossible game of stock picking and towards smart, strategic allocation across these key asset classes.
And that really just leaves us with one final thought. In a world that's constantly telling you that investing has to be overwhelmingly complex, what if the answer was actually much, much simpler? I mean, could just 9 carefully chosen investments really be all you need to build a portfolio that's actually perfect for you?
All right, welcome. Today, we're going to demystify one of the most critical parts of investing, how to build a truly solid portfolio. We're going to focus on creating that unshakable foundation, what the perfect portfolio methodology calls the core segment. So, let's jump right in. To really get a handle on this, we're going to use a fantastic metaphor. I want you to picture your entire investment portfolio as a sleek sailing ship. Now, this core segment we're building today, what is it? Well, it's the ship's ballast.
It's that heavy, hidden weight deep below the water that keeps the whole thing stable no matter what the weather is doing.
So let's take this ship metaphor one step further. See, any good sailing ship really has two fundamental parts that have to work together. And this applies perfectly to your portfolio. It's all about finding that balance between the ballast, which gives you safety, and the sails, which give you speed.
And this slide just lays it out perfectly. On one side, you've got the ballast. That's our core segment. It's all about stability, safety. It's a buy and hold foundation that's designed to keep you steady even when the market gets rough. But on the other side, you've got the sails. That's what we call the target market segment. That's where you're looking for speed, for performance, trying to catch the winds of market opportunity. Now look, chasing those high returns with your sails, that's the exciting part of investing, right? But here's the crucial point. None of that matters if your ship can just tip over and sink. You absolutely have to construct this stable, foundational core segment first. It's the solid base that gives you the confidence to even think about aiming for those high returns later.
So the big question is, what are we actually building this ballast with? What are the key components that give us all that stability? Well, let's break down the actual building blocks. These core investments aren't just any old thing. They have some very specific traits. First, they represent an entire asset class. We're not picking individual hot stocks here. That means they have to be incredibly well diversified, which naturally leads to lower volatility. And because this is your foundation, it should be kinda set it and forget it. It needs very little personal attention and, this is key, minimal expenses.
So keeping those characteristics in mind, the perfect portfolio methodology points to these 4 specific building blocks. I mean, these are the classics, but with a modern strategic twist. You've got cash, bonds, U.S. stocks, and, super important, foreign stocks, which are treated as their own separate asset class to make sure you have true global diversification.
Okay, but what's really fascinating is why these 4? Why these specific asset classes? Well, it all comes down to this really powerful financial concept called correlation. Basically, it's a fancy way of saying we're looking for assets that don't all go up or down at the exact same time. And this table right here, this shows the magic in action. Just look at the relationship between U.S. stocks and bonds. See that number? It's negative 0.17. That means, historically, when stocks zig, bonds tend to zag. They often move in opposite directions. That's the diversification that smooths out your ride and keeps your ship from rocking too much.
Okay, so we know the what and we know the why. Now let's get into the how. Let's look at the simple, practical process you can actually use to select the specific funds for your core. It really just boils down to this 4-step blueprint. It's super straightforward. First, you identify a few potential candidates, like index funds or ETFs, for each of our 4 building blocks. Second, you collect the key data. Third, you compare them side by side. And finally, you allocate your money based on your decision.
Enough with the theory. Let's get our hands dirty and walk through a quick, practical example of how you'd actually use this process to make some real-world decisions.
So here we are at step 3, comparing a few bond funds. We're looking at returns, risk, but pay close attention to that last column, the expense ratio. This is so critical for long-term buy and hold investments. Notice that Fidelity Fund's expense ratio? It's more than double the Vanguard one. Over decades, that tiny difference can cost you a fortune in returns.
And we see a very similar story with the U.S. stock funds. I mean, look how close those performance and risk numbers are. When you're buying the entire market like this, they're often going to be almost identical. And that makes the expense ratio a really smart and easy tiebreaker.
So after going through that same comparison process for all 4 of our building blocks, we've landed on our final selection. We now have one specific, low-cost, super diversified investment for each category: cash, bonds, U.S. stocks, and international stocks. And just like that, our foundation is built.
Okay, we've picked our investments, but we're not quite done yet. There is one final, really crucial step. We have to decide how much of our money to actually put into each of these buckets. This is how we customize the ballast for our own personal journey.
And this table just illustrates it perfectly. You can completely tailor your core to your own risk tolerance. A conservative investor, for example, might put half their money into cash and bonds for stability. But as you move towards a more aggressive stance, you can see how the allocation shifts heavily towards stocks, which is what gives you that higher expected return. So What this all really comes down to is this. The core segment is the steadying force of your entire investment strategy. By following a process like this, you're not just randomly picking funds, you're thoughtfully building a reliable foundation that's designed to weather pretty much any storm the market can throw at you.
And with that stable foundation firmly in place, a really exciting question comes up. What's next? Because building the ballast, well, that was just the first step. Now it's time to get ready to hoist the sails, that target market segment, which is where we can really start to seek out those truly high returns.
So most of us build a portfolio that's, solid and dependable. But what if dependable just isn't cutting it anymore? What if you want to go beyond just steady returns and start aiming for something truly spectacular? In this explainer, we are going to dive into a strategy designed to do exactly that, to supercharge your portfolio.
So let's start with a really important question. Is that safe portfolio, the one everybody tells you is the smart move, is it actually holding you back? Is it limiting your potential for some real wealth? The answer might be yes, but the good news is there's a way to add a high-growth engine to that safe foundation without throwing the whole thing out.
Okay, the key here is to think of your portfolio in two totally separate parts. On one side, you've got your core segment. That's your bedrock, right? Your stocks, bonds, cash. That's the foundation. But on the other side, we have the target market segment. And this is not about slow and steady. Its entire job is to be a rocket booster, to actively go out and hunt for those spectacular returns.
Now, your core portfolio is absolutely essential. Don't get me wrong. It's the bedrock that gives you stability and that nice, steady, long-term growth. Think of it as your defense. But hey, a winning team needs a powerhouse offense, and that's exactly what we're going to build next.
So, how do you actually get there? If your goal is to chase after those really extraordinary returns, you got to add another layer to your strategy. This is precisely where the target market segment comes into play. It's the piece of the puzzle built specifically for investors who are looking for that explosive growth.
Let's just call this second layer what it is. It's the supercharged engine of your portfolio. This is the high-octane, nitrous boost component that you bolt on to add some serious horsepower and just dramatically speed up the journey towards your financial goals.
This quote from the source material just nails it. We are not talking about small, modest gains here. The goal is to hunt down and add assets that are capable of producing spectacular returns. That one word, spectacular, it changes the entire game.
So, what does this segment actually do for you? Well, 4 really important things. First, it unlocks massive potential for returns. Second, and this might sound a little crazy, it can actually reduce your overall risk by bringing in assets that don't just follow the stock market up and down. Third, it gives you the flexibility to move quickly when markets change. And finally, it puts you in the driver's seat, letting your work translate directly into potential wealth.
All right, so you're probably asking, what are these amazing, powerful assets? Well, this whole strategy is built on 5 very specific building blocks, and each one was chosen for its own unique potential.
And here they are, the fantastic 5, if you will, the core components of the target market segment. We're talking about gold, energy, agricultural commodities, real estate, and emerging markets. So let's break down exactly why each one of these is so critical. First up, we've got gold. For thousands of years, this has been the ultimate safe haven asset. Unlike a company stock, it has real, tangible value. It can literally never go to zero. When fear takes over and markets start to tumble, investors historically flock to the safety of gold.
Next up, energy. The key phrase to remember here is intrinsic demand. Our entire modern world runs on it. It's not a luxury, it's a necessity. That creates a constant, growing, and totally non-negotiable demand. A portfolio without some kind of energy component is missing out on one of the biggest forces driving the global economy.
Then we have agriculture. This is about as fundamental as it gets. We're talking sugar, wheat, cattle, the stuff that feeds the planet's billions of people. It doesn't matter if there's a bull market or a bear market, a recession or a boom. People have to eat. That creates an incredible baseline of demand. Next, let's talk real estate. And no, we're not talking about flipping houses you see on TV. This strategy is all about income-producing commercial properties. Think hotels, big office buildings, apartment complexes. These are hard assets designed to generate a steady stream of cash flow, month in and month out.
And finally, emerging markets. This is all about investing in the economies of countries that are growing at lightning speed, places like China, India, and Brazil. Now, yeah, they come with higher risk, but the potential for absolutely explosive growth as these nations come into their own is unlike anything you'll find in the developed world. This is where you find the economic giants of tomorrow.
So, what does this all look like in the real world? Well, check out this table. It shows the returns from 2007, which was a pretty shaky year right before the big financial crisis. U.S. stocks, they brought in about 4.5%. Okay, not terrible. But now, look at the target market assets. Gold, over 30%. Energy, almost 36%. Agriculture, over 31%. The difference here isn't just big, it's absolutely staggering. This is what supercharging a portfolio can actually look like.
So the big idea here, the main takeaway, is that we're targeting assets that have the potential for annual returns of 20, 30, even 40% or more. Now, of course, it's never a guarantee, but that is the incredible upside we're trying to unlock here.
But let's be honest, with great potential returns comes great volatility. This kind of performance can be a pretty wild ride. So how do you manage it? How do you tame the tiger without getting bitten?
This metaphor from the source material is just perfect. When you work with these assets, it's like you've got a tiger by the tail. The power is immense, but so is the risk. The goal isn't to let go of the tiger and run away scared. It's to harness all that incredible power while protecting yourself from its claws. And you do that with a plan.
And that plan is called a trading plan. It's really just a predefined, automatic strategy for when you're going to sell. This is so crucial because it takes emotion, panic, greed, all of it, right out of the equation. It's a system for limiting your losses or locking in your profits. No second guessing allowed.
Now, the star of this trading plan is an amazing tool called a trailing stop trigger. And honestly, it's brilliant. It's a sell order that automatically moves up as your investment's price rises. But, and here's the genius part, it never moves down. It lets your profits run as high as they can go, all while building a safety net underneath them.
Okay, let's walk through a super quick example. Say you buy an asset at $90, then you set a $5 trailing stop. That means your initial sell trigger, your safety net, is at $85. Now, let's say the price shoots up to $98. Your stop automatically moves up with it to $93. It has now locked in profit for you. If the price then drops, your stop stays put at 93. It never ever goes back down. See? That's how you protect your gains.
So, you've got the core concepts down. You know the 5 asset classes, and you've got this awesome risk management tool. Now, how do you put this all together into a process you can actually use over and over again?
Well, the source material lays out a really simple 5-step process. First, you learn, then you identify some potential investments, you analyze the data, and check the price chart. But the most important step here is the last one. You define your trading plan, your entry and your exit points before you ever invest a single dollar. That's what turns this from a gamble into a real disciplined strategy.
So your core portfolio, that's your solid foundation. But a foundation is just the beginning, right? It's just where you start. The real question is, what are you going to build on top of it? Are you ready to add the engine that could truly supercharge your journey to your financial goals?
So, you're thinking about adding some gold to your portfolio. You know, it's one of those things that's surrounded by a ton of hype and, well, a lot of really strong opinions. But what if we just cut through all that noise? What if we used a clear step-by-step process to make a smart decision? Well, that's exactly what we're going to do. Let's dive into a data-driven way to research and maybe add a gold investment to your holdings.
First things first, let's get a handle on what we're actually investing in. Now, you see this chart? And yeah, a massive 75% of gold goes into jewelry. But for us as investors, the real story might just be in those other slices. That 15% for industrial and medical use, that's huge. Gold is an incredible electrical conductor, so it's in all our high-end electronics. It's also biocompatible, which makes it perfect for things like pacemakers. This steady, growing industrial demand creates a really solid foundation for its value that goes way beyond just looking pretty. Okay, so gold has been valuable for, what, thousands of years. That brings up a really important question. Why should a modern investor, someone focused on tech and growth, even give it a second look? What role could it possibly play today? And here's the answer. The whole thinking has shifted. Historically, gold was just a way to store wealth, a heavy, shiny rock you could hold on to. But now, for a strategic investor, it's become an active tool. It's something you use very specifically for portfolio protection, as a shield against certain economic storms.
So why invest in gold? Well, the modern case for it is really built on that strong, growing foundation of demand we just talked about. I mean, think about it. As emerging economies grow, so does the demand for jewelry. And our reliance on advanced electronics and medical tech, that's only going one way, up. All of this creates a powerful, long-term tailwind for gold. All right, now if we're going to invest, we absolutely have to understand what makes the price of gold move. It doesn't exist in a bubble, right? It responds to very specific triggers around the world. So let's break down exactly what those are. These four are the big ones. First, gold is a safe haven. When the markets get choppy or there's a lot of fear out there, investors tend to run to gold, which pushes the price up. It's also a classic hedge against inflation. When your cash is losing purchasing power, gold's value tends to hold up. Now, pay close attention to the US dollar. Gold is priced in dollars, so think of them like a seesaw. When the dollar gets weaker, gold tends to get stronger. And finally, you've got basic economics. There's only so much of it, and more people and industries want it. Okay, so we get the why and the what. Now for the fun part, the how. How do you actually go out and find a specific gold investment to look at? This is where our methodical process really starts to shine. Look, the goal here is super simple. We just need to find at least 3 potential candidates to compare. You don't need some secret Wall Street source. You can start with a fund family you probably already use, like Vanguard or Fidelity. Then, check out some top performers lists online for precious metals. And finally, just browse gold-related ETFs. Those are exchange-traded funds. This little 3-step search will give you a solid list of options to put head-to-head in no time. Now, this next step, this is the most important part of the whole process. We're going to take that list of candidates we found, and we're going to let the data, not our gut, not some guru on TV, make the choice for us. This is how you move from just guessing to making a calculated investment. Okay, just look at this table. The numbers tell a really clear story here. At the time this analysis was done, the returns for all 3 of these were actually pretty similar. So the real decision comes down to the other columns. Look at risk, measured by standard deviation. The ETF IAU has almost half the risk of the other 2. Then look at the expense ratio. That's what it costs you to own it. Again, the ETF is way cheaper. And boom, just like that, the data makes the decision for us. There's no emotion here, no guesswork. In this particular case, the choice was obvious. Getting a similar return potential with much lower risk and much lower fees, well, that made the ETF the logical winner. So we figured out what to buy, but we still need to decide if now is a good time to buy it. And that's where a simple price chart comes in handy. You're just looking for the overall trend. Is it generally heading up? And you also want to try and spot the floor, a price level it seems to bounce up from, which we call support, and the ceiling or resistance. This just helps you avoid buying right at the very peak of a big run-up. And that brings us to the final, and I mean absolutely critical step. You never ever want to make an investment without a plan for how you're going to manage it. Your plan defines how you get in, how you'll take profits, and most importantly, how you'll get out if things go wrong. And a good plan can be beautifully simple. First, you place your buy order. Then, right after you buy, immediately, you set up your safety net, an automated trailing stop. For example, you could tell your broker to automatically sell if the price ever drops, say, 8% from its highest point after you bought in. And finally, you set a price alert on the upside, a target that pings you and says, hey, time to take a look and decide if you want to take some profits. And this quote right here, it just nails why this tool is such a game changer. As your investment's price goes up, your stop level automatically ratchets up with it, locking in those gains. But, and this is the key, if the price starts to fall, the stop stays put. It never moves down. It's your automated, emotion-free tool for protecting your cash and securing your profits. So, while we've been talking about gold, this 5-step process, understanding the asset, analyzing the data, and creating a plan, can be applied to pretty much any investment you're thinking about. It turns what could be a really emotional choice into a logical one. The real takeaway here isn't just about gold. It's about having a process you can use over and over again. So the real question is, how will having a clear process like this change the way you make your next big decision? All right, let's get right into it. Today, we're going to break down a really methodical way to think about adding energy stocks to your portfolio. We'll walk through a disciplined framework that takes a pretty complex idea and turns it into a clear, actionable plan. So let's dive in. We all feel that pinch at the pump, right? But have you ever stopped to think about turning that pain point into a potential portfolio gain? The cost of energy affects just about everything we buy. So it really raises a big question. If it has such a massive impact on our expenses, shouldn't it maybe have a place in our investments too? And that right there really gets to the heart of this whole strategy. See, energy isn't just another commodity you can trade. The thinking here is that it's absolutely fundamental. It's what runs the entire world economy. And because of that, demand for it is practically inevitable. That's what makes it such a crucial asset class to at least consider for any well-designed portfolio. All right, Section 1, Energy, your portfolio's engine. So let's explore why energy isn't just some side bet, but what the author of this framework calls a foundational building block for putting together a stronger portfolio. So here's the key idea. A target market building block. That's not just any old investment. We're talking about a whole category of assets where there's pretty much no doubt about its long-term demand. And on top of that, it has the potential for returns that could blow past the market averages. And you know what? Energy fits this profile to a T, giving it this really unique role that can add some serious diversity. And if you need proof of that long-term demand, just look at the numbers. These projections from the US Department of Energy are just wow. We're not talking about tiny little increases here. Global demand is expected to jump 57% in 25 years. And get this, by 2030, over half, 56% of all the world's energy is going to be used in Asia. Even right here in the US, electricity demand is slated to grow 40%. I mean, those numbers really make a powerful case for the long-term importance of this sector. Okay, the 5-step investment process. So the why seems pretty clear, but what about the how? How do you actually do this? Well, the author lays out this really simple, repeatable 5-step process that gives you a clear plan for finding, analyzing, and then managing an energy investment. And here it is, the roadmap. It's super logical. We start with a big picture, understanding the asset, and we work our way all the way down to defining a specific trading plan. The whole point of a structured approach like this is to take the guesswork and, more importantly, the emotion out of your decision-making. All right, let's move on to picking your energy player. This is where we get practical, starting with step 2, identifying who you're actually going to invest in. So how do you take this huge universe of energy investments and narrow it down to just a few solid choices? Well, the strategy here is simple, but really smart. You buy the whole sector, not just a single company. The author recommends focusing on mutual funds and ETFs because you get instant diversification. Think about it. This way, you avoid the risk of one specific company having a terrible quarter or, some kind of management scandal. Instead, you're investing in the big, broad energy trend itself. So, following that logic, the author narrows it down to these 3 specific candidates. We've got 2 mutual funds, FSENX and PSPFX, and 1 exchange-traded fund, or ETF, which is IYE. Now, the cool thing about ETFs is that, unlike mutual funds, they trade just like stocks on an exchange, which makes them super easy to buy and sell all day long. All right, so we have our contenders. Now let's put them head-to-head. Okay, this is where the rubber meets the road. It all comes down to the data. Now, at first glance, you might look at that 5-year return and think PSPFX is the clear winner, right? But hold on, you have to look closer. It also has the highest risk. That's the standard deviation, which basically just means its price swings up and down a lot more. And it's got the highest expense ratio. But now look at IEY. Yeah, the return is a little lower, but it has the lowest risk of the 3, and its expense ratio is, by far, the lowest. This is that trade-off analysis in action. And so, based on all that data, the final selection is IEE, the ETF. So why that one? Well, because it just presents the best overall profile. It's the cheapest option, it has the lowest risk profile of the bunch, and remember, because it's an ETF, it trades like a stock, which makes it incredibly easy to manage as part of a trading plan. Okay, next section, timing your market entry. So we've picked our player, it's IYE, but listen, that's only half the battle. The next absolutely critical step is figuring out when to buy, and for that, we need to analyze the price chart. And here's what that looks like. This is a 1-year price chart for our chosen ETF, IYE. That squiggly line in the middle, that's the price. And those 2 bands that kind of hug the price line on either side, those are called Bollinger Bands, and they're a great way to help us see how volatile it is. What we're doing is looking for clues in this chart, clues about the price trend and any key levels. So what exactly are we looking for on this chart? Well, 4 simple things. First, the price trend. Is it generally heading up, down, or just sideways? Second, we're looking for support and resistance levels. Just think of these like a floor and a ceiling that the price tends to bounce off of. And finally, volatility. How wide are those Bollinger Bands? The wider they are, the more volatile the price is, and that little detail is going to be super important for our final step. And that brings us to our final section, the all-important trading plan. And honestly, this is the most crucial step of all, because you can do all the analysis in the world, but it really doesn't matter if you don't have a disciplined plan for when you're going to buy, when you're going to sell to take profits, and most importantly, when you're going to sell to cut your losses. So based on that chart analysis, here's the specific plan in action. First, you place a market order at the current price. Second, and this part is absolutely key, you set a trailing stop loss. Now what that does is it trails the stock price as it moves up. It will only trigger an automatic sell order if the price falls a certain amount, in this case, $8 from its highest point. It's an amazing tool for protecting both your initial cash and your profits. And third, you set an email alert at a target price, like 160, as a reminder to check in and maybe take some profits. See? It's a simple plan, but it forces you to be disciplined. And this quote really brings us to the single most powerful takeaway from this whole explainer. Because of its volatility, energy is not being treated as a passive buy and hold investment here. Nope, it's a buy and trade asset. It's something you actively manage with a trading plan, a plan designed to limit your downside while letting your profits run. It's a strategy that requires discipline, but it offers a lot of potential, which really just leaves one last question for you to think about. Is your portfolio built just to hold, or is it built to trade? All right, let's take a trip back in time, shall we? We're setting the clock for mid-2008. Now, this was a moment when some really sharp investors were looking past the usual stuff, gold, oil, and they were focusing on the very staples of life, agricultural commodities. Today, we're going to dive into a fascinating investment idea that basically tried to turn a grocery list into a potential gold mine. I mean, think about that for a second. It's a pretty compelling thought, isn't it? What if your portfolio wasn't just abstract numbers on a screen, but a real reflection of the corn, the wheat, and the coffee that literally fuel our world? That is the absolute core of the strategy we're breaking down today, one that connects huge global economic forces directly to your kitchen table. While oil and gold are always grabbing the headlines, the market for the food we eat is this quiet giant. We're talking grains, livestock, coffee, sugar. It's a colossal asset class. And back in 2008, the argument was pretty simple. This wasn't just some fringe alternative investment. It was an essential building block for any serious portfolio. So what was the big idea here? What made this so compelling? Well, it really boiled down to two things: a surging, almost insatiable global demand for food, and the fact that its price tends to move completely differently than stocks and bonds. And that offered something every single investor dreams of: true diversification. Just look at this number, 50%. A 50% increase in food production needed in just a little over a decade. I mean, that was the staggering projection they were working with back in 2008. This wasn't just some minor trend. It was a tidal wave of demand on the horizon, and it formed the absolute bedrock of this entire investment thesis. Okay, so a 50% jump. Where in the world is all that demand supposed to come from? Well, the author pinpointed three really powerful long-term global trends that seemed destined to drive agricultural prices higher for years to come. First, the most basic driver of all: simple population growth, 3 billion more mouths to feed on the planet. Second, a massive shift in what people were eating. As countries like China and India got wealthier, their growing middle class started wanting more meat and dairy. And producing that protein takes a ton of grain for animal feed. And third, you had this growing demand for corn and sugar to produce ethanol, which was literally taking food off the table and putting it into gas tanks. Now, before we talk about how to invest, you got to understand the two main types of players in this market. First, you have the hedgers. Think of a big company like Starbucks. They buy coffee futures to lock in a price for next year so they don't get a nasty surprise. They're reducing risk. Then you have the speculators. These are folks betting on which way the price will go, trying to make a short-term profit. Both are powerful, and sometimes they move the market for reasons that have nothing to do with the actual harvest. So let's say you're sold on the why. You believe in the thesis. But back in 2008, how could a regular person actually act on it? Well, it turns out the options for an individual investor were pretty limited. You basically had two roads you could take. On one hand, you had the wild roller coaster of trading futures contracts directly, which is incredibly risky and really not for the faint of heart. Then you had a more accessible path: exchange-traded funds, or ETFs, which offered a much simpler, more diversified way to get in on the action. And it's so important to remember the context here. We're in mid-2008. Back then, it was almost impossible to find a mutual fund that only focused on agriculture. This lack of options really made the new wave of ETFs the most practical, really the only choice for most people looking to invest in this space.
Okay, this is where it gets really interesting. This is where the rubber meets the road. The author didn't just talk about the theory, they actually walked through a real-world analysis, trying to pick the best investment with the extremely limited information they had at the time.
The search came down to two main contenders. First up was DBA. This was an ETF that directly held futures contracts for things like corn and wheat. It was a pure play on the commodities themselves. The second was Moo. Now, this one was different. It held stocks in companies involved in agriculture. Think equipment makers like Deere or seed producers like Monsanto. Two very different ways to play the same trend. Okay, now take a look at the data they were working with from July of 2008. The performance difference is, well, it's pretty stark. DBA was up almost 47% in the past year. Moo was actually down. But, and this is a huge but, look at that note at the bottom. Both of these funds were so new that there was basically no long-term data to analyze, no real track record. And the author didn't try to sugarcoat this at all. This one quote just says everything. I am virtually flying blind here. I mean, that's the raw, honest reality of trying to invest in a new and emerging asset class. You have a compelling idea, but you're navigating completely uncharted territory with no map. But, a decision had to be made. And the author chose DBA. So why that one? Well, first, it was a direct bet on the commodities themselves. Second, more investors were trading it, so it was more liquid. And third, you just couldn't ignore that spectacular, even if it was very recent, performance. But listen, picking the investment, that's just step one. What came next was arguably even more important, creating a disciplined plan to manage the investment and, crucially, to control the risk in what everyone knew was a super volatile market. So this is the exact chart the author was looking at. You can see that massive run-up in price over the previous year, and the question on any investor's mind looking at this would be, is this a bubble that's about to pop? How do you protect yourself from that? So here was the game plan. Step 1. Buy shares at the current price, around $42. Step 2, and this is the really smart part, set a trailing stop loss. This meant the shares would automatically sell if the price ever dropped $7 from its highest point since the purchase. This was the safety net, the protection against a potential bubble bursting. And step 3, set an alert to get an email if the price hit $48, just as a reminder to take a fresh look at the whole thing. So if we step back from this 2008 time capsule, what's the real lesson for us today? It's not about whether DBA was the right or wrong pick with the benefit of hindsight. No, the real value is somewhere else entirely. And here it is. This is the crucial takeaway. The specific ETF, the prices, the market conditions of 2008, that's all ancient history now. The timeless lesson is the process, the discipline of building a thesis based on fundamentals, researching the options available, and then executing a clear plan with predefined rules to manage your risk. That applies to anything, whether you're looking at AI stocks today, crypto, or whatever the next big thing is tomorrow. And that really just leaves us with a final question to think about. The products we invest in, the market trends, they're always changing, they're always in flux. But a methodical process, a good process, one that values planning and risk management over just chasing hype, does that ever really go out of style? Thanks for tuning in.
Let's talk about real estate. For a lot of people, that word brings up a mix of excitement and, let's be honest, maybe a little bit of fear. But what if there was a way to get all the power of commercial real estate into your portfolio, but without all the massive headaches? Well, in this explainer, we're going to break down a really smart, accessible way to do exactly that.
Yeah, that quote probably hits home, right? I mean, the memory of the 2008 housing crisis, it still casts a pretty long shadow. The whole idea of diving into property can feel super intimidating, maybe even a little reckless. So yeah, that collective groan, totally understandable.
Okay, so right up front, let's get one thing crystal clear. We are not talking about buying your own house. This explainer is all about something completely different. We're diving into large-scale, income-producing commercial properties. Think shopping malls, giant office buildings, warehouses, hotels, that kind of thing.
And that reputation problem is very real. It comes straight from the subprime mortgage crisis, which you'll remember was a total mess of bad loans that just sent shockwaves through the entire economy. But the investment we're about to look at, It lives in a completely different universe.
So let me introduce you to the hero of our story, the REIT. Honestly, the best way to wrap your head around a REIT is to think of it like a mutual fund, but for commercial property. It takes this huge, complex, crazy expensive asset and makes it accessible for pretty much anyone. So what is a REIT really? Well, it's a company, and its entire business, its whole reason for being, is to own and operate properties that generate income. But here's the magic part. It allows you, the individual investor, to buy a piece of a massive real estate portfolio just as easily as you'd buy a share of Apple or any other company on the stock market. Now this is the secret sauce. This is the rule that makes REITs so incredibly powerful for investors. To even qualify as a REIT and, avoid paying corporate taxes, these companies are required by law to pay out at least 90% of their taxable income back to shareholders as dividends. What does that mean for you? It means these things can be absolute income-generating machines. You see how brilliant this is? It's a total win-win that Congress set up way back in 1960. The companies get this huge incentive, avoiding corporate taxes, to organize this way. And what do investors get? A steady stream of income and the chance to own a slice of incredible properties they could never, ever afford on their own. It's a beautiful thing.
So, let's get into the good stuff. What are the actual, tangible benefits of adding a REIT to your investment mix?
All the advantages are huge. First off, you get instant diversification. With one single click, you can own pieces of dozens, maybe hundreds of properties. It also solves all the classic real estate problems. Unlike owning a building, your investment is super liquid, you can sell your shares in seconds. Plus, you get professional management, and your personal risk is totally limited to what you invested. And maybe best of all, no phone calls at 2 a.m. about a broken toilet.
Okay, so that's the what. You're probably on board. Now for the how. Let's build a really practical framework for actually choosing the right REIT for you.
First thing you have to know, and this is super important, is that there are two main flavors of REITs. Over on the right, you have mortgage REITs. They're basically in the business of owning loans and mortgages. But our focus, where the real action is for us, is over on the left, equity REITs. These are the ones that actually buy, own, and manage the physical buildings. This is about real, tangible ownership. And even within that world of equity REITs, the variety is just incredible. You can find REITs that focus on just about anything you can imagine. Malls, apartment buildings, office towers, hotels, hospitals, even giant industrial warehouses. And as we're about to see, that variety is your absolute best friend. And this slide shows you exactly why that diversity matters so much. Picture this. The same weak economy can hit different types of properties in completely opposite ways. So, when people cut back on vacations, yeah, hotel REITs might take a hit. But at the exact same time, if people are downsizing from houses into apartments, apartment REITs can actually boom. That's why investing in a REIT that holds a big mix of property types is so critical. Okay, let's get practical and look at some real-world options from back in mid-2008. Now, there are a few numbers here, but the one I really want you to focus on is the expense ratio. That's the fee you pay every single year just for owning the fund. Look at T. Rowe Price. They're charging 0.73%. Now look at Vanguard, just 0.2% for pretty similar performance. Over the long run, that difference is massive. For our strategy, we want the lowest cost possible, which makes that Vanguard ETF, VNQ, the runaway winner at just 0.12%.
So after that little bit of analysis, the choice becomes pretty obvious. The Vanguard REIT Index ETF, ticker symbol VNQ. It's got that broad diversification we want, it's an ETF so it's super easy to buy and sell, and most importantly, it has a rock-bottom expense ratio. That means more of your money stays your money.
All right, we've found it. We've identified our ideal investment. So, the million-dollar question is, do we buy it? Is now the time to pull the trigger?
Well, let's take a look at the data. This was the price chart for VNQ at that time. You don't need to be a Wall Street genius to see the trend here, right? The price was going one way and one way only, down. And so, here is the big twist in our story. Even though we have found the absolute perfect investment for our goals, the timing is just completely wrong. The smartest, most disciplined, and frankly, the hardest decision here is to wait.
But waiting doesn't mean forgetting about it and walking away. No. It means you shift from an active buying mode to an active monitoring mode. And the tool you use for that is called the watch list.
A watch list is such a simple yet incredibly powerful idea. Instead of just buying something and hoping for the best, you create a specific monitoring plan. You set price alerts that will ping you when something important is happening, basically telling you, hey, it's time to take another look. So here's exactly what that plan would have looked like for VNQ. We'd set 2 specific alerts. The first, an upside alert at $68 a share, which might signal the trend is reversing. And the second, an alert if the price fell all the way down to $55, which was a historical support level where buyers tended to show up. But, and this is the most important part, step 3, an alert is not a signal to automatically buy, it's just a signal to come back to the table, do your homework all over again, and reevaluate the situation.
And this quote just sums up the whole philosophy perfectly. Being a smart investor isn't just about what's in your portfolio today, it's also about what you're actively watching. Every potential piece of your financial puzzle should be monitored so you're ready to make a smart move when the time is actually right.
Which leaves us with this one final, critical question to chew on. We did the work, we identified the perfect investment vehicle, VNQ, but in the end, the most valuable lesson wasn't about what to buy, it was about when. So I'll leave you with this. What do you think is more important? Finding the right thing to invest in or finding the right time? It's a question every single one of us has to answer.
All right, today we're going to add a really dynamic building block to our investment toolkit, emerging market stocks. We are literally searching the globe for some potentially amazing returns, and we're going to use a super clear framework to do it.
But first, let me ask you something right off the bat. Is your portfolio really global, or are you maybe missing out on some of the fastest growing economies on the entire planet? It's a huge question, and it's exactly what we're here to tackle.
You know, the core idea we're exploring is a really cool shift in thinking. Forget just investing in goods like gold or oil for a second. What if you could invest in places? We're talking about the economies of whole countries like China, Brazil, and India. And this is a big deal because it gives you true diversification. You get exposure to economic engines that might be firing on all cylinders when your home market is kind of taking a breather.
Okay, so first things first, we got to be on the same page. What is an emerging market anyway? Let's quickly define this incredible world of opportunity.
See, the key word here, the really important one, is transitioning. An emerging market isn't just sitting still. It's an economy that is actively on the move, upgrading its systems, building new roads and ports, and, crucially, opening its doors to investors like you and me. It's an economy in the middle of a glow-up.
And hey, don't think this is some tiny niche corner of the market. We're talking about absolute giants like China and India, resource powerhouses like Brazil and Russia, and whole booming regions like Latin America and Southeast Asia. The opportunities here are literally all over the map.
Okay, let's be real for a second. The chance for high returns almost always means you're taking on some unique risks. So before we go any further, it's absolutely vital to understand what those are. Because when it comes to emerging markets, it is definitely not always smooth sailing.
So the risks here are kind of a mixed bag. Some are very specific to one country. You know, a surprise election, a sudden change in trade rules, that kind of thing can totally shake up a local market overnight. But then there are bigger risks, like what the US dollar is doing. If the dollar gets stronger, it can actually hurt the value of all your foreign investments. It's this whole web of factors you've got to keep an eye on.
So how in the world do you deal with those risks that are tied to just one country? Well, the strategy from the source material is honestly pretty brilliant. Don't just buy a bunch of stocks from one place. No, you diversify by buying a basket of stocks from a basket of countries. It's a fantastic way to smooth out the ride. All right, so we know how to hedge our bets with diversification, but how do you actually pick something? Let's dive into this simple two-step process for sifting through all the global options to find a potential winner.
Think of it like a funnel. We're going to start really wide, with a 30,000-foot view of the entire world just to see which region has the most momentum. Once we've pinpointed that hotspot, then we zoom in to find the best specific investment within it.
Okay, let's see this process in action. And I've got to stress this. The data you're seeing is a historical example from way back in mid-2008. The whole point here is to show you the method, okay? This is not a hot tip for today. Cool? So as you can see, the author used ETFs as a quick way to gauge performance. And wow, back in this snapshot in time, Latin America was just crushing it.
And just like that, step 1 is done. The data told us exactly where to look next. We've narrowed our search from the entire world all the way down to just Latin America.
Now for step 2, let's zoom in. Here, the author lined up a few different funds focused on that region at that time. And you can see the returns were all pretty great, right in the same ballpark. But look closer. Check out that expense ratio. That's the percentage the fund charges you every year. That's the real story here. This is so important. I mean, why would you pay way more in fees if you're getting basically the same performance? It just doesn't make sense. So based on this data, that iShares ETF, symbol ILF, looked like the obvious winner.
But hold on a second. It's never that easy in investing, is it? As it turns out, there was a little wrinkle, a practical problem with this otherwise perfect choice.
And here's the problem: $280. Now, that was the price for a single share of that ETF back then. And when individual shares get that pricey, it can be a real pain to allocate your money properly, especially if you aren't working with a massive portfolio.
But the solution is actually super smart and pretty simple. If you love the investment idea, in this case the Latin America index, but you hate the share price, you just find another, cheaper fund that tracks the exact same thing.
And that is what led to the author's final selection in this example, GML. It gave you exposure to the very same basket of stocks, the S&P Latin 40 index, but at a much more manageable $89 per share. See? Same investment, just a smarter way to execute the trade.
Okay, so the choice is made, but we are not done yet. Now comes what might be the most important part. What do you actually do with this information? We need a concrete action plan.
So the author then took a look at the price chart from that period, and what it showed was a really solid long-term uptrend, but with a little dip happening right at that moment. And that little dip was seen as a potential green light, a chance to buy into that strong trend while it was on a temporary sale, basically.
And all of that analysis leads to this really disciplined three-part plan. Step 1, buy it. Simple enough. But immediately after, you go to step 2, protect yourself. You set what's called a trailing stop loss. Think of it as your safety net. It automatically sells for you if the price takes a dive. Then, step 3, you plan for success. You set an alert at a higher price. This isn't to sell automatically, but it's a little tap on the shoulder to tell you, hey, things are going well. Maybe it's time to take another look. You see? It's a complete game plan for managing both your risk and your potential reward.
You know, this whole process isn't just a one-time trick. It's a repeatable framework you can use over and over again to hunt for opportunities anywhere on the globe. So we'll leave you with one final question to think about. Using a model like this, where in the world will your portfolio find growth next?
Okay, let's talk about something really important. Are you just kind of throwing money at investments and hoping for the best? Yeah, let's change that. We're going to break down how you can stop guessing and start engineering a portfolio that's built just for you. All right, so first things first, we have to bust a huge myth right out of the gate. So many people are looking for that one perfect portfolio, the magic bullet that's going to solve everything. Well, here's the truth. It just doesn't exist. At least not in the way you're probably thinking. And that right there is the crucial shift in thinking. The best portfolio isn't some secret recipe you find online. Nope, it's a custom blueprint that you build. It's the portfolio that is perfect for you and only you. So how do we actually do that? How do we build that blueprint? Well, we're going to walk through a simple 4-part process. First, we'll create your plan. Then we'll look at the 3 dials you'll use to build your portfolio. After that, we'll design your custom mix. And finally, we'll make sure it actually hits your target. Okay, part 1, creating your plan. Look, it all starts right here. I think the single biggest mistake investors make is just investing without a specific goal in mind. It's kind of like setting sail on a boat with no map and no destination. You're just drifting. We're going to fix that right now. And you know what? The process is actually pretty simple. It's just 3 steps. First, you set your goal. What's the target amount of money and when do you need to buy? Second, you figure out your contributions. How much can you start with and how much can you add every month? And from those 2 things, you can calculate your required return. That one number, that becomes the North Star for everything else we're about to do. Okay, to make this real, let's walk through a case study. Let's imagine an investor. They're starting with $100,000, and they plan on adding $300 a month. And they've got a pretty ambitious goal. Turn that into $2 million in just 15 years.
And here's where the plan hits a dose of reality. When you run the numbers, to hit that goal, their portfolio would need to return almost 21% every single year. Whoa, that is a huge number. Just to put that in perspective, the stock market's long-term average is closer to 12%. Trying to chase 21%, that means taking on some serious, probably dangerous levels of risk.
So what do? You adjust the plan to make it more realistic.
And check out how simple this is. Our investor makes two small, totally doable changes. They just extend their time frame by 2 years, so 17 years instead of 15, and they bump up their monthly contribution by just $50. And get this, with just those two minor tweaks, the new required return drops all the way down to 17.9%. Now that is a much more achievable target. And this number, 17.9%, that is the specific target their portfolio now has to be designed to hit. Okay, so we have our target. Now for part 2, your 3 portfolio dials. This is the fun part. We're going to look at the toolkit, the actual controls we use to build a portfolio that can hit that 17.9%. And what I love about this method is how simple it is. We're only going to work with 9 basic building blocks. That's it. We split them into 2 buckets, a conservative core segment for stability and a more aggressive target market segment for growth. And we control the whole thing with just 3 simple dials.
Okay, dial number 1 is the big one, the segment dial. Think of it like the master volume control for risk. It decides how much of your money goes into that stable core bucket versus how much goes into the high-growth target market bucket. This is your main lever for setting the risk and reward for your entire portfolio.
Next up, we have the core dial. This one lets you fine-tune things inside that stable foundation. So within the core bucket, you can decide, do you want a little more growth from stocks or a bit more safety from bonds and cash? You're just tweaking the balance in there.
And finally, the third dial. This is where you can really put the pedal to the metal. The target market dial is all about being dynamic. This is where you put your money into those more aggressive assets based on what's hot right now, what's actually trending up in the market today. All right, so how does our investor actually use these dials to aim for that 17.9% target? Let's dive into part 3 and see how they actually design their custom mix. Okay, so remember that 17.9% is a pretty high target. So to get there, they have to turn that main dial, the segment dial, up pretty aggressively. They decide to put 60% of their money into that high-growth target market segment, leaving the other 40% in the stable core. Now let's look inside that 40% core segment. Even though we're calling it stable, they're still aiming for growth here. See how they have a combined 60% in US and foreign stocks? Why would they do that? Well, because their time horizon is 17 years. They have time to let that grow, while still keeping a nice 40% cushion in safer stuff like cash and bonds. And this is a perfect example of how that target market dial works in the real world. These choices aren't just random guesses. They're based on what's happening right now. Gold gets a big chunk because markets are uncertain. Energy and ag are in there because their prices are trending up. And see how emerging markets only gets a small piece? That's because they're being a little cautious, since that trend seems to be cooling off. Okay, so now for the moment of truth. We've made our plan, we've turned the dials, and designed the portfolio. So the big question is, does it actually work? Does it hit our investor's target? Let's find out. All right, so here's how the numbers shake out. The core part, the stable 40%, is expected to return about 8.4%. The target market part, the aggressive 60%, is projected to bring in 19%. So you blend those two together based on that 40-60 split, and you get the total expected return for the whole portfolio. And that comes out to 14.7%. Now hold on, that's a great return. But wait a minute, remember our plan? Our plan requires 17.9%, so we're a little short. Is it time to panic? Did we fail? Absolutely not. This is probably the most important part of the whole process. It's not one and done. It's a loop. You just go back and tweak the dials. It's that simple. For example, our investor could just nudge that main segment dial up, moving the target market from 60% to maybe 70%. That one little change would boost the expected return and get them much, much closer to their goal. So let's just wrap this whole thing up into a clear 5-step action plan for you. 1. Create your plan and find your personal required return. 2. You gotta do your homework and figure out the expected returns for each asset. 3. Set your 3 allocation dials. 4. Calculate the total expected return for your mix. And 5. Compare your portfolio's return to your plan's required return and just keep tweaking until they match up. Simple as that. Look, at the end of the day, your financial goals are unique to you, so shouldn't your portfolio be unique too? This whole framework is about giving you the power to stop following some generic advice you read somewhere and start engineering a portfolio that is custom-built for your goals, your timeline, and your take on the markets. It lets you design something that truly, finally works for you.
All right, so you've done the heavy lifting. You've thought it all through, and you have this perfect vision for your ideal investment portfolio. But let's be real, a plan on paper is just, well, paper. How do you turn that blueprint into a real, working, wealth-building machine? That's what we're diving into right now.
So yeah, your perfect portfolio is designed. You've got the plan, you know your goals. The big looming question is, now what? How do we take this amazing concept and actually make it work for you in the real world, day in and day out?
It's time to build the machine. We're going to set up a system that pretty much automates all the tedious day-to-day stuff so you're not glued to a screen 24/7. A little bit of focused work right now is going to pay off big time, letting your investments run with some serious efficiency down the road.
So here's our game plan. We'll start by going from plan to reality. Then we'll get into the nitty-gritty of implementation, actually building this thing. After that, we'll cover monitoring, which is like setting up an automated watchdog for your money. Then we'll get into the long-term management of it all. And finally, we'll see how this all adds up to you having a truly empowered investing career. Let's do it.
You know, the goal here is actually pretty simple. We want to keep your portfolio on course, even when the market is going haywire. This system we're building is all about making that day-to-day management super easy and effective, so you can stop sweating the small stuff and focus on the big picture. And this whole process really just boils down to 3 critical actions. First, implementing. That's buying your assets and getting your trading plan in place. Second is monitoring, knowing what to do when your system flashes a warning sign. And third, managing, making those regular tweaks to keep everything on track.
All right, let's kick things off with implementation. This is where the rubber meets the road. We're taking your plan off the page and turning it into actual investments in a real account. It's time to lay the foundation.
First things first, you need the right tools, and that means picking the right online broker. And listen, it's not just about finding the cheapest option, it's about finding the right capabilities. For this system to work, you absolutely need a broker that offers different order types, especially trailing stops, and lets you set up triggers and alerts. Honestly, these tools are non-negotiable. And of course, you want a website that's easy to use and support that actually helps you.
So when I say reasonable commissions, what does that even mean? Well, to give you some perspective, when the source material for this was put together, the industry average was just under $7 per trade. So in that context, paying more than, say, $12, that's probably a bit much. It's just a good benchmark to keep in your back pocket.
Okay, here is a massive pro tip for you that can really boost your returns. You know that target market slice of your portfolio, the part that involves more frequent buying and selling? To avoid getting hammered by taxes on those gains, think seriously about putting those investments in a tax-advantaged account, like a traditional IRA. That way, you can defer the taxes until you retire. It's a game changer.
Let's just quickly zero in on the trailing stop, because it is the absolute heart of your automated system. Imagine you buy an ETF at $100 and you set a 5% trailing stop. Your first sell price is $95, but if that ETF climbs to $120, your sell price automatically follows it up to $114. See? It's an incredible way to protect your downside while letting your winners run.
Okay, let's move into the monitoring phase. Your system is built, and it's now watching your investments around the clock. Think of it as your own automated watchdog. But here's the thing. A watchdog's only useful if you know what to do when it starts barking.
Now, you've got a really crucial choice to make here. Are you a hard stop or a soft stop person? A hard stop means your position sells automatically when the price gets hit. It's awesome for taking emotion completely out of the decision, perfect if you're more hands-off. A soft stop, on the other hand, just sends you an email alert. That gives you a nudge to do some research and make the final call yourself. That's better if you're a more hands-on investor.
So, let's play this out. Your system does exactly what it's supposed to do. An automated hard stop triggers and sells one of your positions, protecting you from bigger losses. Great. So what do you do now? Your response is actually a simple 3-step routine. First, that cash from the sale is now free and clear in your account. Second, you start scanning for other opportunities in your plan. Where can you reinvest that cash? And third, you put the asset you just sold on a watch list and set an alert, so you'll get a notification if it starts to bounce back. Simple. Okay, so we've got implementation and monitoring covered. Now we shift gears into long-term management. I want you to think of this part as steering the ship. The engines are running automatically, but you're still the captain, and you need to check the course now and then.
For this, you need a good online portfolio manager. This is the dashboard for your machine. Your broker probably has one, but you need to make sure it's got the right stuff. Clear performance data, custom alerts, and, this is crucial, a tool that analyzes your asset allocation. You need to see if your portfolio is starting to drift off course. This is exactly why you should put a recurring monthly review right on your calendar. Don't skip it. During this checkup, you'll review your performance and your allocation, but you're also going to be on the lookout for a hidden portfolio killer, something most investors totally miss.
And that hidden killer is something called a time stop. This is a personal rule you set for yourself. If one of your investments has just gone sideways, not up, not down, just stagnant, for a certain amount of time, say 3 months, you sell it. Why? Because your capital is way too valuable to be dead money, just sitting there doing nothing when it could be working for you somewhere else.
So let's bring this all home. By putting this system into place, you're not just managing a portfolio anymore. You're launching an empowered investing career, where you, and only you, are in the driver's seat.
So here it is, your final action checklist. 1. Get your plan together. 2. Pick the right broker with the right tools. 3. Place your orders in the right accounts. 4. Set up all your stops and alerts. 5. Schedule those monthly reviews. Don't forget. And number 6, and this is a big one, commit to always learning. That's it. That's the process for taking full control.
And that last point about learning, it's everything. Every single trade is a chance to get smarter. That includes those incredibly frustrating whipsaw sales, where you get sold out of a position right before it turns around and skyrockets. You learn from it. And every time you make the perfect call, you learn from that too. This whole journey is about constant growth. So there you have it. You've got the blueprint. You know how to build the engine, how to set up the dashboard, and how to read all the alerts. Your well-oiled machine is built and ready to go. The only question left is, are you ready to be its pilot?
What if you could take all that time you spend researching investments and turn it into a real, measurable boost for your portfolio? Well, today, we're diving into a super powerful idea from the Perfect Portfolio methodology that lets you do exactly that. We're talking about putting you in the driver's seat of your own returns.
Look, you're an engaged investor, right? You put in the time, you read the articles, you do the research. But have you ever had that feeling where you're just spinning your wheels? You jump on some hot tip, you follow the hype, and nothing. All that effort feels wasted. You need a system, a structured way to make your involvement actually count for something. So what's the answer? Imagine you have this dial. It's not for risk, it's not for your asset mix. It's a dial for your personal involvement. The whole Perfect Portfolio methodology is built around this idea. As you turn this dial up, as you put in more focused time and effort, you can directly crank up your portfolio's potential. Let's see how it works.
Okay, so the first turn of the dial, this is all about how you actually pick your investments. We're moving past a quick, yeah, that looks good enough approach. Instead, you're going to dedicate more time to really digging in and selecting the absolute best assets for your portfolio's building blocks.
And this is where it gets practical. First, learning more doesn't just mean reading headlines. It's about really understanding why an asset moves so you can spot opportunities others miss. Second, widen your search. I mean, this is huge. It's the difference between picking the best of 3 choices versus the best of, say, 30. Next, use third-party help, but be smart about it. You've got to filter out the noise and only listen to advice that's backed by solid data. And finally, you can even diversify inside a single building block. Like buying an ETF for traditional oil and one for clean energy. It's a great way to hedge your bets.
Let's turn that dial a little further. This is level 2. This is where we go from being a more passive investor to taking a really active role. It's all about keeping an eye on market conditions so you can make smart, timely tweaks to your portfolio.
And here's the trade-off, right? On the one hand, if you're watching the market, you can see big events unfolding before your price alerts go off. That is a massive advantage. But the danger? Drowning in information overload, all that financial noise. The key is to train yourself to ignore the day-to-day chatter and only pay attention to the big stuff, the major events that can really move the needle.
Think of this table as your playbook for turning headlines into action. You see that interest rates are on the rise? Okay, that usually puts a damper on stocks and real estate. So you might decide to dial back your allocation there. Or maybe the US dollar is weakening. Well, that can be a huge tailwind for foreign and emerging markets.
The whole point is that the PPM is designed to be flexible so you can quickly adjust and hopefully capitalize on these big shifts. All right, let's crank the dial up to level 3. This is where we graduate from just looking at basic charts. Now we're going to start using some more advanced tools to really fine-tune our buy and sell decisions. So one of the simplest and honestly most effective tools out there is the Relative Strength Indicator, or RSI. You've probably heard of it. All it really does is measure the speed and change of price movements. It helps you see if an asset has maybe moved too far, too fast, and might be ready to reverse course. And you only need to remember 2 numbers, 70 and 30. That's it. When the RSI gets up near 70, we say the asset is overbought. It might be getting a little pricey and could be due for a pullback. And when it gets down near 30, it's considered oversold, meaning it might be a bargain that's ready to bounce back. Simple, right? So here's how you actually use it in the real world. Imagine you get that email alert that one of your investments has hit its soft stop price. Okay, instead of just automatically selling, you take one extra step. You pull up its chart and you check the RSI. If that RSI is, say, at 50 or 60, nowhere near that oversold 30 mark, that probably supports your decision to sell. But what if it is near 30? That might be a sign that a rebound is coming, and you could decide to hang on for a bit. It just adds this crucial extra layer of data to your decision-making. Okay, it's time to turn the dial all the way up. We're at level 4 now. This is for the truly involved investor. We're talking about actively customizing the very structure of your portfolio by adding your own specialized building blocks. The 9 core building blocks in the PPM are designed to give you fantastic market coverage. But let's say you have some specialized knowledge, maybe in healthcare or technology. You can absolutely add those as new blocks to your portfolio. There's just one rule. You have to treat them with the exact same discipline. You still have to do the research, the selection, and the management, just like any other block. No cutting corners. And this is where it gets really, really interesting. Level 4 is also where you can bring in what we call doomsday building blocks. These are short ETFs. Think of them as a way to bet against the market. They're literally designed to go up in value when a market is going down. So instead of just playing defense and trying to lose less during a downturn, these tools let you go on offense and potentially make a profit from the fall. Just look at this chart. It perfectly shows their power during that big downturn from 2007 to 2008. The S&P 500 index lost 20%. Ouch. But a standard short ETF that bets against it, it gained 20%. And an ultra-short ETF, which is leveraged, it gained a staggering 40%. This is how the most active investors can find ways to generate returns no matter what the market is doing. So we've gone all the way from just sharpening our investment picks to actively customizing the very bones of our portfolio. You know, the beauty of this whole personal involvement dial concept is that there's no single right setting. You get to choose your own level of engagement. And please, remember this. Mastering any of these levels is a journey. This quote really says it all. You're going to learn from experience. You'll set some stops that are too tight and some that are too loose. That's okay. With every decision, with every trade, you're just going to get better and better at this. Which brings us to the final and most important question, the one for you. What's the right setting for your dial? How much of your time and your effort are you willing to exchange for potentially higher returns? Are you happy with a simple, effective, low-maintenance approach? Or are you ready to start turning up that dial? The choice and the potential that comes with it is completely up to you. Thanks for watching. All right, let's talk about a totally different way to approach investing. One that claims to challenge, well, pretty much everything we've been told for decades. It's called the perfect portfolio methodology. And honestly, it just might change how you think about building your own wealth. So, does this question hit home for you? You know, for so many of us, investing feels like this massive, tangled mess of advice and confusing jargon. It can feel like a problem that's just impossible to solve. You know, it reminds me of this really famous old story, the Gordian knot. The legend goes it was this crazy, complex knot, and whoever could undo it would rule all of Asia. So people tried and tried to untangle it, but no luck. Then along comes Alexander the Great. He just takes out his sword and boom, slices it right in half. And that's really the core idea here, that for regular people, modern investing has become our own Gordian knot. It's this tangled web of picking stocks, analyzing funds, just trying to make sense of it all. And the old ways of untangling it, they're just too complicated for most of us. So what's the big Alexander solution for our investments? Well, it's this thing called the perfect portfolio methodology, or PPM for short. And instead of trying to untie that impossible knot, the PPM just slices right through it with a much simpler, bolder approach. So how does it do that? How does it actually work? Well, the whole thing is built on 6 breakout ideas that pretty much flip conventional wisdom right on its head. They create a totally new way of looking at how you build your wealth. Okay, first up, it throws out that old 3-asset straitjacket. Just stocks, bonds, and cash. Instead, the PPM uses 9 totally distinct asset classes, and each one has its own unique personality. This gives you way more flexibility to build a portfolio that can actually do well no matter what the market is doing. Second, and this is a big one, forget about trying to find that one magic stock. The PPM uses things like ETFs and index funds to buy entire markets all at once. What does that mean for you? It basically gets rid of the risk of one single company blowing up your portfolio, and it saves you the massive headache of trying to analyze thousands of stocks. Number 3, it's not just buy and hold forever. The PPM uses a trading plan with specific buy and sell rules. The goal is to automatically cut your losses at a point you decide on beforehand, while letting your winners keep on winning. Now, this is absolutely crucial. It means you can shoot for higher returns without having to take on more risk. Fourth, it brings in a factor that traditional finance just ignores: your own involvement. The idea is that by simply paying attention and making informed choices, you can actually lower your risk. It's kind of like you're trading a little bit of your time and attention for a safer portfolio. Fifth, you get total clarity. Let's be honest, a lot of investors don't really know what they own or why they own it. With the PPM, you've got a maximum of 9 investments. That's it. You know what every single one is, why it's there, and exactly how it's doing. The mystery is gone. And finally, number 6. Instead of some super complicated, rigid portfolio design, you are in control. You can change your entire risk level just by tweaking the percentages you allocate to those 9 building blocks. So if market conditions change, you can react fast. Okay, so that all sounds pretty good in theory, right? But what about the real world? Let's dig into a great story about an investor named Gloria, who decided to put this whole perfect portfolio thing to the test. So meet Gloria. She's a retired healthcare pro, and her portfolio was kind of all over the place. She felt like it wasn't doing much, and she even admitted she wasn't really sure what was in it. So after learning about the PPM, she decided, okay, I'm going to try this, and put $100,000 of her own money on the line to test it out. So a year goes by, and Gloria decides to meet with a financial advisor at one of the big firms. She shows him her portfolio, just 8 simple ETFs. And right away, he's skeptical. He sees things like gold and energy funds and tells her it looks very risky. But Gloria, she was ready. She calmly explained that her risk was completely under control. For her more aggressive investments, she had a trading plan in place that would get her out if a position dropped more than about 7%. But it would let her profits run as high as they could go. I mean, what a great example of the PPM in action. The advisor, though, he wasn't buying it. He started talking about how his firm's professionals were the real experts. So Gloria made a very simple suggestion. She said, let's just compare results. She asked him to pull up the performance of his firm's main investment fund for the year before, 2007. And the results, well, they speak for themselves. The advisor's big, professionally managed fund, it returned 5% in 2007. Gloria's simple, self-managed portfolio, 17%. That's more than triple the return, and she didn't even start until partway through the year. The difference is just staggering. But wait, it gets better. Performance was only half of it. The advisor's fund charged a 1.8% management fee every single year, plus a 5% sales fee right off the top. Gloria's portfolio? The fees were around 0.4% plus a couple of small trading fees. So let's get this straight. She got triple the returns for a fraction of the cost. So what happened? Well, the meeting ended. And the very next day, the advisor called Gloria and told her his schedule was, quote, extremely full and he couldn't take her on as a client. Turns out, her simple, low-cost, high-performance strategy just didn't really fit his business model. Now, Gloria's story isn't really about bashing financial advisors. It's about something bigger. It's about empowerment. It just goes to show what can happen when a regular person takes the time to learn a new way of doing things and then actually has the drive to see it through. So, what's the big takeaway from all this? The perfect portfolio methodology is really positioned as a path to financial freedom. It's all about declaring your independence from the gatekeepers, taking personal control of your money, unleashing your own potential to build wealth, and finally, taking responsibility for your own future with confidence. And that really leaves us with one last powerful question to think about. After seeing this completely different path, one that's all about simplicity and control and your own personal involvement, who do you really believe is the best person to be in charge of your financial future?